Greetings, friends. Today, I'm going to tell you about a man who managed to beat the system and predict the crash that occurred in 1987. A very significant date, isn't it? But let's take it one step at a time. Paul Tudor Jones is the man to whom today's video is dedicated. He was born in Memphis, Tennessee, to an ordinary family without any legendary trading roots. His father worked in finance, but it wasn't the son of a billionaire kind of thing. It was the typical American way, where a lot had to be earned through one's own wits and strong character. There was no room for weakness. Even in his youth, Paul was distinguished by the fact that he constantly looked how people make decisions, behavior under pressure, and react to fear and greed. And this observation of human nature later greatly influenced his trading. He attended the University of Virginia, majoring in economics, and simultaneously developed a fascination with the market and how it all worked. But let's take into account the fact that things were much more complicated back then, at the very least, because there weren't social media like today, where you could find answers to any question. Back then, you either understood the market or you didn't. Things are much simpler now. For example, I have my own Telegram channel where I hold daily trading sessions and recruit copy traders so you can earn with me. Incidentally, this is a great opportunity for those who didn't want to spend a ton of time learning. To join, you can follow the link down below in the description and subscribe. And as a bonus, every week I hold a giveaway for 100% bonus of your deposit. To participate, just write, "I want to join the giveaway," down in the comments below, and I'll send you a special link. But let's get back to the story. After university, Paul entered the brokerage world, working in the cotton market. He didn't immediately achieve success. Moreover, he made mistakes, and he himself later said more than once that these mistakes shaped his attitude towards risk. He saw how traders could be right but lose money simply because they didn't know to control their position size. He understands that even you're right, you can still lose your deposit. This is where the idea for which everyone will know him begins to form: risk management. Early in his career, Paul actively used technical analysis charts, levels, and trends. He viewed charts as a reflection of the crowd behavior, and if you could read them, you'd gain an advantage, but again, only if you controlled your risk. Sometimes he would strictly limit losses. If the market was going against him, he'd exit without emotion, not because he didn't care, but because he accepted the loss as part of the process. And he never entered a trade thinking maybe it'll work out. He always had a plan. Where to enter, where to exit, where to admit an idea hadn't worked. Over time, he began to accumulate capital experience and reputation. He founded his own company, Tudor Investment Corporation, and reached a completely new level. He didn't just trade. He built a system combining macroeconomic thinking and technical analysis, looking at major cycles, interest rates, currency behavior, and inflation, but still looking for entries and exits on a chart. Because, as he himself said, the market can remain irrational longer than you can remain solvent. And then there's that very year for which even those who aren't particularly deep into trading know him: the crash of 1987. It wasn't his refined intuition that helped him, and he himself noticed the overheating. At that moment, Paul saw the market repeating patterns from the past because he had studied history, including the Great Depression of 1929. He noticed similarities in price dynamics, market participants, behavior, and the acceleration of growth before a crash. And this was where technical analysis played a role. Our hero didn't wait for immediate confirmation, but rather built positions so that in the event of a crash, he would not simply protect himself, but profit. Even here, he distributed the risk understanding that the market could move against him, in which case he could or would simply exit with a controlled loss. His strategy didn't allow him to bet everything on a single idea, no matter how brilliant. And when the market actually crashed in October 1987, his fund performed phenomenally. He not only survived, but also increased his capital. It was after this that people began to talk about him as a trader who didn't just trade, but understood the market, the structural and the psychological levels. Paul Tudor Jones himself later said repeatedly that this success didn't make him overconfident. On the contrary, it made him even more cautious. Incidentally, for him, money was never a goal in itself. It was simply a scorecard that showed him how well you were making decisions. His approach to risk management was extremely strict. He never risked a significant portion of his capital on a single trade, but rather anticipated that trades would be unprofitable, and that was normal. It's not normal for a single loss to wipe out months or years of work. So he always started with a question, not how much will I earn, but how much can I lose if I'm wrong? And only if he was comfortable with this risk would he enter into a trade. This thinking seems simple, but it's precisely what almost no one follows in practice. Paul Tudor Jones' technical analysis was based on simple principles. He didn't overload charts with dozens of indicators. He focused on trends, key levels, market structure. He observed where prices accelerated, slowed, and began to distribute. Paying attention to extreme moments, he understood that the market couldn't move indefinitely in one direction without correction. He always looked for moments when risk was minimal and potential movement was greatest. He often said that his best trades were the ones where he felt virtually no emotion, because everything was clear before he entered. His approach to the market was very pragmatic. He didn't romanticize trading, but rather considered himself more of a craftsman doing his job every day. And this mindset served him well, because even after 1987, the market didn't get any easier for him. There were periods when he made mistakes, when the market didn't behave as expected, but only through risk management did Paul always stay in the game. In essence, is the main lesson he left behind for the market and for us. Gradually, his approach became a model for many. He began to be seen not just as a trader, but as someone who could sense the market. This was based on experience, statistics, and observation. His story of 1987 crash looks less like a fortunate coincidence than a logical consequence of his approach. He saw the market entering a phase of, so to speak, extreme optimism. He saw growth accelerating, and like the crowd losing sight of risks, any negative news being ignored. And for him, this was a wake-up call. He didn't wait for the market to fall to begin thinking, but prepared scenarios in advance, so that when the worst case scenario materialized, he could simply act on it. After that, the name was firmly cemented into the market history. And frankly, when you look at Paul Tudor Jones' approach from today's perspective, you realize that the market has changed technically over the decades. New tools have emerged and movements have accelerated, but fundamentally, nothing has changed. People are still just as fearful, greedy, hopeful, and unwilling to admit to their mistakes. He said that if you can't explain your trade in simple terms, then you don't understand it. Because most trading mistakes are made not due to lack of knowledge, but because of your head is full of jumbled thoughts. Paul understood perfectly well that the market doesn't have to do what you expect it to. So, he never got attached to a single idea. The market could be bearish today and bullish tomorrow if the structure changed. And when you look at Paul Tudor Jones' entire career, it becomes clear why his name still resonates so loudly. It's not because of one lucky prediction or the 1987 crash, no matter how often it was mentioned, but because of consistency. He adhered to the same principles for decades and never strayed from the fundamental risk management, discipline, understanding the market, structure, and respect for the price. The market is always right, and if the price goes against your idea, it's wrong at that moment. And that's not a tragedy, just information. In such moments, he clearly distinguished between confidence and overconfidence. Confidence is when you have a plan and follow it. Overconfidence is when you begin to believe the market is obligated to listen to you. Paul Tudor Jones' story shows that you can be aggressive in your ideas, but conservative in your risks. You can see a big move, but not bet everything on it. You can make mistakes, still make money. Because success in trading isn't the absence of mistakes, but the ability to live with them. Thank you for watching this video to the end. If you found this story helpful, if you found yourself thinking about trading and risk differently, be sure to like and subscribe to the channel. Also, head to my Telegram channel where I regularly discuss my trades, markets, and psychology, how to avoid losing your capital in one go, and much more. The link down below in the description. I'd love to see you there.